Diversification is one of the largest benefits that we have in fractional real estate investing that is difficult to achieve in real world real estate investing. But I think a lot of people are sort of missing the boat when it comes to creating a truly diversified fractional real estate portfolio. Oh, hey, what's up, YouTube? It's Joe Cacciapaglia sitting on the couch making some money investing in fractional real estate online, as usual. So I want to get into, if you ever used to watch Kramer, he had this, you guys know who Kramer is? I think he still exists. Yeah, because there's that whole inverse Kramer thing. But so, he used to have this segment called Am I Diversified, where people would call in and they'd tell him like five stocks that he owned or that they owned. And he'd say, oh, well, these are in different industries. Yep, you're diversified. I always thought this was pretty laughable, right? Because you can have an index fund that has hundreds or thousands of stocks, and then you're truly diversified. But I think it's hard in the stock market world to have five stocks. And I think a lot of people are kind of thinking about fractional real estate in that same way, where they're like, oh well, I've got properties in 4 different markets, and it's 3 property, or seven properties, and quite a bit of diversification. And I just think, there's so much opportunity. And I've talked a little bit about why you want to diversify, right? Like, when you have, there's 2 different types of, portfolios that you could imagine of investments, right? One's where, there's several different kinds, but in general, you can have a portfolio where your biggest winners have the largest impact on your returns. You could also have a portfolio where your biggest losers have the largest impact on your return. And I believe in real estate in general, it's the latter, right? You're going to have bigger losses. Your losses are going to be of a larger magnitude when they do happen than your gains are going to be. Now, they're going to be much more rare if you're doing things properly. But the ability to get completely wiped out exists with real estate, where you don't have like these 10 baggers that you have, or 100 baggers even that you have in the stock market or some other types of investment, right? You're not going to get just these crazy 10x, 100x returns in some short period of time in real estate. But you can lose, you can lose everything. A great return on a real estate deal might be 15, 20, 30%. So because of that, having, the more diversified that you can be, protecting against, a loss that's a large percentage of your portfolio, creates a real benefit for us. And especially if we're doing it in a way that we're also trying to kick out losers whenever we can, right? We're trying to identify the ones that are going to underperform or that have the higher risk. And I talked a lot about this last year when I was talking about some of the thoughts in The Most Important Thing, the book by Howard Marks. But anyway, so I always mention, I want to have a diversified portfolio, and it helps reduce your risk. And, a lot of times people say diversification is the only free lunch, and it's really not. You're not getting it, meaning that, you get protection and there's no downside to it. I mean, the downside is if you have a concentrated portfolio and you happen to be right that you've picked only the best properties, then you'll do, much better than the average. But like we just discussed, in real estate investing, picking, having a concentrated portfolio of the best winners isn't going to outperform the average by very much. But if you happen to have a concentrated portfolio of the worst losers, you'll have significant underperformance, right? And so that's why I think even more, I think diversification is even more helpful in this industry than it is in the stock market. I'm not a stock guy, but this is my impressions from, reading about a bunch of this stuff and understanding the difference between real estate is not a fixed income asset, but it behaves more like one than it does like a stock. And so that's where a lot of this thought process comes from. Anyway, So I want to talk about the different ways that we can actually be diversified, because there's a whole bunch of them, and I think that this is sort of lost on some people. And then also, whenever we're thinking about each level of diversification, you have to think about, okay, is this adding too much work, too much time and effort, or are we incurring additional outside risk that makes it not worthwhile? So, for example, the first type of diversification, if we're thinking about types of geographic diversification to start with, we can say, okay, I want to buy U.S. properties or international properties, assuming you're in the U.S. like I am. Well, I'm somebody who's decided I'm only going to buy properties in the U.S. for right now. That rules out a whole bunch of potential places where I could diversify my portfolio. But when I've dug into property rights in a lot of other countries, I just haven't gotten the same level of comfort that I truly understand them the way that I do in the U.S. And because I don't always understand the laws and customs around some of the transactions and the way the investments work and the way foreign capital going into those places work, I'm not going to take the time to do that for a bunch of different countries. And also, I think that it's just, even if I did take the time to understand it, I think that there's just an extra level of risk that I'm not going to be able to get past. And so for me, that I've decided, okay, I'm not going to diversify into foreign investments right now. You can also think about geographic investment diversification as, okay, cities versus suburbs, right? Like if I'm going to invest in the city, like I'm someone who very much likes investing in large MSAs, large cities. I moved to San Antonio several years ago, in particular because I thought it was one of the most undervalued large cities in the U.S. It's a top 10 city. I think we actually just moved into sixth place, passing up Philly. But we're priced like we're, some third tier city in the Midwest or something. Not quite that cheap, but it's it felt very undervalued, and it's one of the reasons I moved here and invested in real estate here. But I think when you're looking in the city versus out of the city, I'm someone who has primarily focused on within the city limits of most places. For a couple of reasons, but I think that you get if you're outside of city limits, sometimes you'll have buildings that didn't were built with no code, or they didn't have to. There's no code inspector. They didn't have to follow building codes when they built. Now, it doesn't mean that the properties aren't great, but it does add a layer of risk there. I think that you have you're more susceptible to economic downturns when you don't have a large diverse city that's driving your population. At the same time, if you've looked at some of the mega trends over the last several decades, you've seen like urban cores have lost a lot of population to the suburbs, right? And so I don't necessarily need to be out in the country, but being suburban has had its benefits, although there's some counter trend to that in certain markets, but overall this is something to think about. Are you somebody who is only investing in downtowns and major MSAs? Are you only investing in suburbs? I think there's people that, if you look at their portfolios, they're only doing either, and depending on what the trends are in their markets, that's something if those trends are shifting, there's a lot of benefit to having some in both, right? Also, I think there's a lot of people that say, okay, I'm not going to invest at all in blue states. They're in general very anti-landlord, anti-property rights. I moved to Texas from New Jersey. I've done a lot of real estate work in New Jersey, Pennsylvania, New York. It is so much harder to be a real estate investor and a landlord in those states than it is in Texas. I also have a lot of clients that come to Texas from California, and the same thing, right? It's just that they have it's very difficult to be a landlord. There's a lot of anti-landlord type rules. You can call them pro-tenant rules, but when there's, the interests are not aligned, that makes them anti-landlord, right? At the same time, you see in some of the blue states, they because of those rules, it creates a real disincentive to build new housing. And so a lot of the property markets in those states have unbelievably high rent growth or unbelievably high appreciation, at least. Sometimes not the rent growth because there's specific laws, limiting that, but especially appreciation. If you are artificially dampening, people's appetite for building. So there's some argument to be made that you might want to be in some of those states. And so again, this is a situation where I want to be in as many states as possible. I want to be as spread out as possible. Is it worth it to go into some of the states where I think, me as a landlord or as a real estate investor might not have, the most favorable outcome in the court systems, right? When I was only buying whole properties, making the move from New Jersey to Texas makes a ton of sense. Now that I'm buying fractions of properties, spreading out into some of these other states, I think makes a lot more sense. If you look geographically, I guess I should have pulled up my Lofty Assist to show you. Lofty doesn't have a map, but Lofty Assist does. You can look there. Mogul also doesn't have a map of your portfolio, which I'd like them to add. Ground Floor has a map, but this is just a map of the places where I've had repayments already. I'd love for them to create one that shows a map of my current loans. I mean, I have over 100 loans. I think I have around 120 LROs. I'd like, there is certainly a concentration, but I'd like to be able to see that. Arrive does this nice job of, giving you a little pinpoint where each one is, and they actually break down, okay, by color code, like what type of property it is. But you can see, okay, it's still have this little bit of a concentration here. ARC 7 always logs me out the fastest. They are, let's look at the portfolios, what I'm trying to see here. Okay, I get something on the left coast there, and then a little bit over here. So that's, haven't had I guess I had one loan in California too, but that was repaid. Collab, I've got something in California and something in New Jersey. Real Bricks, everything that I own on here. Oh, I don't have my portfolio open, but all of them are in the same city in Texas. These are all three are in Princeton, Texas. I haven't made a purchase on here yet, but on Tyrios, the one I mentioned and did the video on yesterday, they're all in one single market, right? So if I'm looking for geographic diversification, I'm certainly not going to get it on Tyrios or on Real Bricks. You'll get a little bit on Mogul. They're in 5 or 6 markets at the moment. Is that enough markets? Maybe. Arrived, I think, just has tons. Ground Floor has a ton. Lofty has quite a few. ARC 7 is not in too many, but they have several. So probably less than Lofty actually. And Collab has it's pretty limited markets that they're in, but more so geographically, you can certainly get you can diversify across all of those different aspects, right? Which is if you think about if I was going to buy whole properties, it would just never happen, right? I'd never have, even though, I've only been investing in fractional real estate for about a year and a half now, and have just a wildly more diverse portfolio than I ever could have imagined having buying whole properties. So geographic diversification obviously is one that I think we should all strive for. I don't see a true downside to it, as long as each time we're looking at another market, we're thinking about the risks in that market, right? I'm not just blindly trying to get that diversification. I want to make sure the time that it's taking me to research and the additional risks that there might be there, I think are important. And the next big thing is strategies, right? And you can have okay, do I have both debt and equity? It's two different ways of buying properties. Right now in the fractional real estate space, ground floor is the only one that you have truly fractional debt. A lot of the platforms have funds. So like Arrived has their private credit fund, which is debt, but it's not fractional, right? You don't get to like pick your individual properties. You're just investing in the fund. I have quite a few discussions about, why I don't like investing in REITs, and funds are sort of the same thing. I mean, they're not the same, but it's the same idea as I want to be able to pick all my individual properties, all my individual loans. And so like Lofty, you have the ULD that, again, that's not fractional real estate. It's not, I'm not picking, I'm getting, that's basically investing in a fund that invests in individual loans. Is that technically what it is? No, probably not, because we're controlling it and whatnot, but it is, you don't get a choice. You're not picking, you're buying into a package of loans there. And so at the moment, ground floor, like I said, is the only one that I'm on where, you can buy just individual pieces of debt. Before I forget, please like and subscribe. In the description of this video, I have links to all the places where I'm currently investing in fractional real estate online. All the ones I've mentioned so far, except for Tyrios, I'm actually have some investment in. Some of those links are referral links where if they'll give you some extra dollars if you invest, and some of them might give me something as well. You want to read the terms of service for those, and what you actually have to do to get there. I've had some people, use the links and say, oh, well, I didn't get my money. But most of the time, if you actually read it and do what you're supposed to do, I haven't had any problem with that, except for a long time I had a problem with Lofty. That seems like they have that fixed. If anybody's actually gotten a referral fee from Lofty since they say they fixed it, I'd love to hear about it. But my main point for mentioning all of those is that I want you to make sure that you're doing your own due diligence on all the platforms. Just because I'm providing links to them or because I mention them doesn't mean that you should invest on them, right? You want to make sure that they're a good fit for you, for what you're trying to do. So do your own due diligence on those platforms and any properties that you see me talk about. Also in the description of this video, I have a link to the Discord channel that I set up, where we have a couple hundred people in there now. We're just talking about fractional real estate investing in general. There's no cost to it. It's not a sales funnel. If you join, you probably will get DM'd from a fake me. And please just report that person. I'm not ever trying to DM anybody trying to sell you something. So if that does happen, it is an imposter account. So just know that. And please report them, and definitely don't send them any money. Okay. So debt and equity. Why is that important? So I think that there's definitely, do you have to only invest in equity versus debt? Or could you create a portfolio that's safe without having any debt, or vice versa? I think the answer is yes. For me, I think that debt is it's the surest path to cash flow, right? It is you have income coming in the form of interest, and you have no associated expenses. So the worst thing that can happen when you're a holder of debt is that you stop getting income. The worst thing that can happen when you're holding an equity is that you stop getting income, but you continue to accrue expenses. And so you can have negative cash flow. And with equities, where with debt, there is a floor, right? All you can do is go to zero. You can't have a situation where you're losing money on a monthly basis. And so that to me is very appealing, especially, as I've gotten older and I've gotten more secure in my financial position. I've moved more and more of my investments to the debt side. I think from an asset preservation perspective, it is, it's a much more, it's safer. And this is just generalities, right? It doesn't mean that every loan that you invest in is going to be safer than every property that you invest in. But on the spectrum of safety, I think debt is going to give you generally a safer return, generally a more stable cash flow. Now, ground floor, it's not actually set up to pay you monthly interest, and so you have to purchase a whole bunch of LROs that have a different payoff dates, if you want to have any sort of regular payments. But I do almost virtually every single week. I have payoffs in my portfolio with just 120 LROs on there. There's also, as far as strategies go, you have short-term rentals, long-term rentals, mid-term rentals. These are. I've only been talking about residential real estate because, again, could I invest in commercial as well? Yes, that would be another type of diversification. I think for me, and I have a lot of experience in commercial real estate, but I understand that in order to do the amount of due diligence I would want to on a commercial property, I'd have to just be making much larger investments per deal. And so for me, it's not practical to want to diversify into a lot of different commercial properties because of the time. And if I didn't take that time, then I think, it would just be too much risk, right? But within the residential, investing, there is short-term rental, long-term rental, mid-term rental. All of these are potential strategies. They all work, they all have a different risk profile, and at different points in time and in different markets. I think that there's benefit to some or the other, and I like that. Lofty recently added this thing that breaks down like how many of your properties are in each type of that. And they're actually working on changing this a little bit to move the cash flowing part out of there, I think, which will be fantastic, because that's not a type of property, right? It's a different type of category. I don't have, at the moment, Mogul's not giving you any sort of thing like that, but they do have, if you look at what they have available right now, they have long-term rentals, Airbnbs, pad splits. So long-term rental, short-term rental, mid-term rental, all of those are available here. Arrived is doing long-term rental and short-term rental. I don't think they have any pad splits or anything that would be considered mid-term. Arc 7, I think, kind of the same as Arrived. Collab is the only one that's doing purely student housing out of all the ones that I invest in. So I think it's a sort of different thing there. It is, I don't really even know what I would call that, because it's just basically following the semesters, I believe. And then Real Bricks is all long-term rental. Tyrios is all long-term rental. But, I think, could you only invest in long-term rentals? Yeah, obviously, that's a possibility. But there are, one of the things is, with market cycles, there's certain points in time that it's very difficult to find a long-term rental that's going to give you any kind of cash flow. We're in one of those market cycles right now. It's one of the reasons that Mogul was only doing pad splits and Airbnbs for a long time, because they weren't able to get the types of returns they were looking for with long-term rentals. Now that rates have come down a little bit, now that it's a little bit more of a buyer's market, they've started to put out some long-term rentals. But if you're not looking, I think there's some true benefit to be had of having a little bit of each, because in a down economy, I think the pad splits will do better in the long-term rentals. And when the economy starts booming again, if there's more travel, I think the vacation rentals, the short-term rentals should do better. And then another way to diversify is as far as strategies go, is with cash flow versus appreciation. And this is one we actually had a little discussion in the comments of a recent video. A lot of people talk about appreciation is the icing on the cake. This is, I don't know why, but for some reason that phrase always rubs me the wrong way, because it's something that I think a lot of investors just don't spend enough time thinking about. is this a market where I'm going to get better appreciation than other markets? Is this a neighborhood or property type I'm expecting to get better appreciation than other, and so I think it should be a deliberate part of your strategy. I understand, obviously I don't like it to be the only, I'm not going to buy a property that I'm losing money every month, hoping to make some outsized appreciation at the end of the day. But I have very often in the past bought properties with extremely low cash flow, solely because I believed, certain aspects of the property or the market lend themselves to, having a much greater potential for long-term appreciation. I think you can, a lot of people think like, you hear people say cash flow is certain and appreciation is gambling. And I just don't believe that at all. I think that a lot of the things that you do to predict cash flow are, you're having to make assumptions and predictions about the future in the same way that you are about appreciation. You just have to look at different factors, right? And the other thing, though, I think it is a little bit harder because appreciation tends to be controlled by the macro economy more. But I think it's certainly something where I can predict which market's going to appreciate better. So relative appreciation is pretty easy to predict, I believe, or at least as easy as it is to predict cash flow. But yeah, but because you're controlled by macro forces, you might not get right like the actual number, the amount of it. But over my career of being an investor in real estate, which is since 2005, I've made significantly more money on the appreciation side than on cash flow, even though for a very long time I was focused on the cash flow side of the equation. Today, what I really look at is I want enough cash flow that there's a margin of safety. So that property, even if things go south a little bit, there's still enough cash flow to cover everything, right? That's my main concern, like with Tyrios having this 3% or 2.5% cash on cash return. The reason that really scares me, not because I necessarily need the yield. I think they're in a market that I'd expect to do very well over the long run. Whether, what the long run is, how long it takes to get there is also debatable. And if we've finished the recent decline that they're in, is also as well. But what I worry about is, okay, if we're off on our predictions a little bit on the cash flow side, is that going to turn into a negative cash flow, right? Versus being just slightly positive. So, but I think that in general, in my portfolio, if you look at, like, for example, what I have in Lofty, everything, and I guess appreciation, there's market appreciation, and then there's also forced appreciation or, buying at a discount. So you're getting equity right away, which is, it's not really forced appreciation, but it's equity versus cash flow. If you look at my Lofty portfolio, almost none of my properties are cash flowing. My Lofty portfolio made more money, made the highest returns last year, higher than any other platform. I think it came with a lot more risk, and it came with a lot more work doing the trading, but it came primarily from buying discounted equity and then selling when token prices went up, or selling the properties in real life. And so I think that if I was solely focused on cash flow, especially on a platform like this, I think I'd be in a lot of trouble. Now, I think Mogul, Ground Floor, Arrived, it's one of the reasons where I stayed away from Arrived and Arc 7 early on, is I think without the discounts, they had very, very low stated returns, right, as far as their cash flow goes. And yeah, in Tyrios, it's the same thing, right? If it weren't for the fact that they're offering a 20% discount, I'd have no interest in investing in these, even though I think it's a market that I'd really like to be in long term, simply because I think we can do better from a yield perspective and still be in a market that I think we're going to get decent appreciation over the long run. Okay, so Am I getting too far off track? I hope not. Yeah. So those are types of strategy diversification. You also have timing diversification, right? And what is that? That has to do with, am I investing in things that, all these different platforms have different hold periods, right? And am I buying a bunch of stuff and I'm going to end up having everything sell off at once, and I'm going to be sitting in cash at a point in time where, if everything paid off at the same time, is that going to be problematic for me because the market is at a certain point in the market where there's no way for me to reinvest, or there's only poor investments to make? Or am I having, is nothing paying off for a very long time, and so I'm not getting any good opportunities to reinvest if when the time comes in certain markets. And so that's one of the things, can play a really big role in your, if you're buying whole properties. Some people just plan to hold forever, which, this is a whole another discussion, and it's going to aggravate people, but I think that, the hold forever is a terrible strategy if you're trying to maximize your returns, right? If you're just trying to minimize your work, which I think is a perfectly legitimate goal, well then yes, once you get, 5 or 10 properties and never sell them, then you're done, right? But if you're actually trying to maximize the returns that you get in your real estate portfolio, there are times that you should be harvesting equity. And, obviously if rates are low, you can do that with a refinance. But if they're not, like in today's world, it's often a good idea to sell and reinvest. It's just a math question. But some people sort of get religious about, I never sell, right? I'm have 30-year fixed rate debt and I'm never going to sell. I just don't think that that's the right approach. I think it's the right approach for a lot of people, but I don't think it is the way that you maximize your returns. So anyway, timing is something that I think a lot of people really aren't thinking about in the way that they're investing. So like on Lofty, I have a lot of money that's been churned quite a bit. It's allowed me to do really well on there because I'm turning it over regularly. It actually, on Lofty in particular, is something that I think people are ignoring way too much. So, for example, when you have these really cheap token prices, right? Like where we can buy, something that was a $50 token, we can buy it now at $15. That's amazing, right? Getting this discount is amazing if we can turn this into a sale sometime relatively soon. If we're going to get stuck holding these tokens for a long period of time, that discount becomes less and less important as time goes on. Now, it is still a benefit, but it can be the difference between making, extremely high returns on an annualized basis, and having the ability to roll them over multiple times, and making sort of mediocre returns because your 30% discount got spread out. You realized that discount with your sale, but it was spread out over 3 years or something like that. And so one of the things that I am trying to be a little bit more intentional about when I'm buying on here is not just looking at, okay, how deep of a discount am I getting, but also how likely is it that we are, as an ownership group, going to sell this property? Because if we're not going to sell it in real life, that discount's probably going to sit there forever. And so, maybe not forever, but for a long period of time. And so, I'm only getting whatever benefit I get from the cash flow. So, for example, this is 90 Madison one. This is that I don't think that there's any chance that there's the ownership group in here. It's pretty concentrated ownership. I don't think that they're going to sell this on the open market anytime soon. I bought these. These are some of the only ones that I've bought at a premium. I haven't bought very many at a premium. But I think that if my goal were to buy this discounted, it's why I'm not really picking up much at the discounted market price. It would make my yield a little better, of course. But right now, the only reason I would want to buy this is for yield, because the discount that we get is going to be nerfed. The effects of it is nerfed over a very long hold period, where some of the ones that I think that we can buy into and potentially sell quicker. Like, for example, this is why I've bought a lot into 7014 Raymond Ave. I don't think there's going to be any resistance to a sale on this one once we get the tenant out. And so even though it's not nearly as good of a property from a lot of different perspectives, it's one that I think the path to a sale is pretty obvious. Just like Lipford was like this as well. This is one, I think it is going to close soon if it hasn't already. Winkler was like this, right? Like the ones that I think that there's more benefit in buying the ones that we can quickly sell. I think that's all I'm going to say about that. So that's timing. And then the most important thing, and for types of diversification that I think a lot of people are really missing the boat on, is platform diversification. Because, so for example, we've seen several platforms either have major problems across the whole platform, or actually, so like if you had all of your money invested on Lambda, you could have had pretty good, well, they didn't have great geographic diversification, but they had a little bit. You could have, I don't know about, but you could have had a somewhat diverse portfolio on there, but then just lost everything when the platform itself had a problem, or had all your money tied up for a long period of time. And, as stuff sells off, you're getting pennies on the dollar, right? And so you're not only actually losing principal on a lot of those deals, you also have the opportunity cost of that money was stuck. You couldn't do anything with it. You couldn't even just take the loss and sell and take your money and reinvest elsewhere. And so that's one of the reasons, like, a lot of people are like, oh, well, if Lofty went under, we still own those properties. If Mogul goes under, we still own, we still have the ownership interest in those properties. The same can be said for just about all the platforms. But the logistics involved and the time and the lawsuits, you might not be able to touch that money for a very long period of time. The properties could be mismanaged during that. They'd probably be taken over by a receiver. It could be years that you go without having any sort of real return, where your asset value gets eroded. And so, I certainly don't want that to happen. It's why I don't believe I'll ever have all my eggs in one platform basket. And then in addition to that, within the platform, if it's one that's like Lofty, where you have different managers, I want to see diversification across managers too, right? Like, one of the things, there's only a couple managers on Lofty right now that I really like. But, having a concentrate, if I were only investing in Lofty, excuse me, and then only investing with one particular manager, I have 100% platform risk, and then I have 100% manager risk. And so you just never know. As much as, people have come to trust Earl, ecosystems, and S&P and M1, like something, one of them could get hit by a bus. Somebody could go off their meds, like you just never know. Like Alec was doing a fantastic job with his couple of co-ownership properties, and then took over a whole bunch, and people trusted him. And I did, I voted for him to take over some of the ones that I owned. And, it's been really rough owning some of those properties. Now it seems like he's starting to get his footing and get going again. But if I had all of my net worth invested, all the money I was investing in real estate was on Lofty and with him, or, much worse case scenario, all of it was with Thunder Sun Homes or with Yom, you would have been just decimated, or, your money would have been just stuck in limbo for a while, and who knows what the end result's going to be, right? So that's the type of, I think you're really missing the boat if you're only on one platform, and, I understand, like, people sort of get attached to one, they want to support one. But that is what, to me, I see as being the biggest risk, right? Is all of these are new companies, or relatively new. I mean, Ground Floor has been around 10 plus years. Arrived has been, some of them have been around for five or 6 years at this point. It's not a very long time. A lot can go wrong. So I just, for me, I don't see the downside, right, in spreading my investment across. I mean, for me, it's all of these right now. Not on Tyrios yet, but I have a little bit at least in every single one of these. I'm going to be, I plan to put more in Arc 7, more on Arrived. If Real Bricks, I don't know, they need to give me better data on the income side. But once their secondary market opens, if there's deals to be had, then certainly I'll be putting more on there. Obviously, Mogul, and I even added a little money on Lofty for the first time in quite a while recently. They're doing a lot, making a lot of changes. They seem to be listening more to requests, and they've specifically made a couple of changes that I had mentioned in a video. But I mean, I see it. Max seems to be really active in the Discord, asking people for feedback, looking for things. So I've liked the change of tone of a lot of that, and maybe it's just that they have a different, it's a different messenger at this point. I don't know, but it is. I think it's promising. And that, combined with it being the only platform that just has these massive discounts and the ability to, get some outsized returns. But I certainly am never going to put all my eggs in that basket, right? No, I think that, is it going to be 5 or 6? Is it going to be, one of the things too is, like, these platforms like Real Bricks or Tyrios, and even like Mogul to a lesser extent, if you have a team that is out there really learning a market and buying in that market, I think they can outperform in that market. But you're not going to get the geographic diversification by just investing on that one platform. So because of that, I just think there's going to be this natural, not a need, but a benefit of being on lots of different platforms. I think it is why it'll be good if, I've mentioned a few times, there's some companies that are trying to create some sort of like aggregation sites where you can track your portfolios across all the different fractional real estate sites. That'll be fantastic when, if and when that actually happens, because it's tough to sort of get a real sense of, okay, what do I have? What do I have as far as geographic diversification, and as far as short-term rentals and long-term rentals, and all the different types of diversification I just talked about. If I were trying to get a snapshot of the portfolio that I own, it's not easy to do without just creating my own spreadsheets and charts and whatnot. And so hopefully we see that coming along sometime in the near future. Like I said, I know there's people working on it now. It'll be interesting to see how that works out. But yeah, those are all the different types of diversification I think we should, we can think about. If there are others that I didn't mention, I'm curious if there's ways, other types of diversification that people are going for. If you think there's a good argument against this, right? Like why you want to just pick one platform and go all in on it, or just pick one one location, one type of property. Let me know. Put it in the comments. Jump in the Discord. Let's talk about this. I think it's something that like I said, I mean, we don't get the benefit of this when we're buying properties in real life, right? If I'm buying, it's chunkier purchases. It's I usually physically go there. There's just so many reasons that I'm just not going to have hundreds of properties in real life, right? And so this is, in my mind, one of the best benefits of fractional real estate investing, and one of the reasons I believe fractional real estate investing can outperform real world real estate investing, because I do think there's a tremendous advantage to being able to have extremely wide diversification in this manner. And so, if that being the case, I just want to make sure people aren't just sleeping on this, right? Aren't just thinking, oh, let me get 4 or 5 properties on one platform and I'm good to go. And obviously, however you want to do your own investment, you have to decide what's right for you. Just because I think that this is the way to go, I think there's probably some arguments against it. Like, so for example, Earl being all in on Lofty, I think makes some sense because he's, one, I think he owns some stock in the company. I don't know if that's a meaningful amount or not, but more important than that though, is I think he, he's bringing a lot of properties on there. He's using the platform as a business development tool for his property management business. So, from those angles, he's just getting a lot more benefit from the platform than just as a passive investor. And so whenever I'm talking about this, I'm typically talking about from a passive investor's point of view. But even with those other things, being the case, I still don't want to ever just be, have my business be too tied to another business that I don't control, right? I think that creates some existential risk for anybody who's doing that. But yeah, anyway, that's all the stuff that I wanted to talk about today as far as that goes. I'm curious, do you think you have if you think you have a diversified portfolio, drop it in the comments. Just let me know. Like, yes, I think I'm completely diversified. No, if you're not, let me, which kind aren't you, right? Like, do you need to work on the strategies? Do you need to work on geography? Do you need to work on platform diversification? Yeah, I think that's it. I rambled for long enough for you guys today. If you're still watching this at the end here, I really appreciate the support. It is fun doing this, and I love the community that we've built, and that, people, I'm learning stuff from other people in here all the time, people sharing info and, pointing me in the direction of new platforms and all kinds of stuff. And I think that that's exactly what I'm looking for. So thanks a lot for that, guys. Anyway, until next time, I'm going to just keep making mistakes so that you don't have to.